As stocks are continuing to decline today due to concerns about the valuations of artificial intelligence-related stocks. My next guest believes that the AI narrative driving the stock market rally still has the potential for growth. However, the concentration of performance within this equity sector resembles the final stages of the dot-com boom. But just how much? We'll take a look at that. But let's welcome in Doug Peta, Chief U.S. Investment Strategist at BCA Research. Doug, thanks very much for joining us today.
Thank you, Roger.
You feel there is room still in AI right now?
I do. I think we can take whatever the hyperscalers, the 5 largest investors in the AI data center build out, Amazon, Google, Microsoft, Oracle, and we can take, and also Meta. I think we can take whatever they have said they plan to spend for 2026 and assume that that is a minimum level of investment, given the way that their projections for AI CapEx have routinely been revised higher with every quarter. So I do think, at least in the near term, absolutely there is scope for more investment, and there is scope for the narrative to attract even more investment and for the stocks to continue to rally, at least in the near term.
I want to bring in a couple of charts we had made up. Hopefully you can see these. And you compare, it's comparing where we're at now and the dot-com bust in 2000. And can you see these charts? Can you break them down a little bit how the two final deciles compare?
Now, unfortunately, I can't see the charts, but are these from from BCA's own publication?
Yeah, they are. Yep.
Okay. Great. So, all right. Please tell me if I'm not describing the correct chart.
Well, I'll tell you, the first one we have up is the final decile of 1990 to 2000 of the bull market then.
Okay. I can see that. Yes. So look, what you can see there, and this is why we wrote about it in our Monday publication, is that pretty extreme concentration. And that, in fact, in the final decile of the 90s bull market, which spanned from April 16, 1999 until the conclusion in March 24, 2000, only the information technology sector managed to outperform the overall S&P 500. And as you can see, and any terminal user will recognize these abbreviations as the Bloomberg abbreviations for the sectors, that we had 6 of them: energy, utilities, financials, materials, healthcare, and consumer staples, actually lost ground in absolute terms. So it wasn't just that the tech names beat the S&P 500, it was the tech names that dragged the S&P 500 to the 17% performance over those last 11 months. We have something similar shaping up today, which is why we included this chart. And you can see here now we've got 4 of 11 sectors that have been losing in absolute terms over. Now, this decile is just provisional. We don't know how long the bull market is going to last. But if it had lasted through last week, this would represent the last decile. And we've got 4 of the 11 sectors negative, and financials sitting right there on the 0 line. This has been powered by tech, the third from the left, and telecommunication services, which includes Google and Meta and Netflix, is second from the left. I would submit that healthcare, look, that's a one-off. It's a recovery from having really lagged over for a little while. So that I don't think the healthcare is necessarily a part of this story, but it's clear that we've got increasing concentration that is very similar to where we were in that 1990s bull market.
Okay. And I just want to get out, we're not quite out of time, but I want to get a couple more questions in going the other way. And it's from the economy and the consumers. We saw Home Depot come in today with disappointing earnings. They're off today. How concerning is that we're seeing that K-shape right now?
Well, I do think it's concerning. I think it suggests that the expansion may be living on borrowed time. And as relates to the bifurcation among consumers and the K-shaped consumer economy, I have 2 points. One is that the bottom leg of the K is getting larger and larger. Its ranks are swelling as stresses for American households have spread from the very bottom of the wealth and income distribution, I would say, to at least the middle of the wealth and income distributions. Point number two is I believe the lower leg of the K is more important for the business cycle than the upper leg of the K. The notion that wealthy households can keep spending for as long as stocks keep going up and thereby keep the expansion going, I think is flatly wrong. It is the lower half of the distribution that matters more.
And how do we change that then? How do you think that can be changed?
Well, look, the way it can change in terms of the swelling ranks of the lower leg of the K is if the labor market turns around and we start to see meaningful job creation. The last 4 months data that we have through August, U.S. net non-farm payrolls growth has been between 25,000 and 30,000 on average. So that's really tepid. That is not enough to stop that lower leg of the K from swelling, and therefore to stop a large component of American households from having less capacity to spend, and as in the consumer sentiment charts that were just shown, having less willingness to consume.
Okay.
There's got to be something to reverse that weakening willingness and diminished capacity for the expansion to revive, for growth to accelerate again, and for the expansion to continue going in robust fashion.
Okay, we're going to have to end it there, Doug, but thank you very much for joining us.
Thank you, Roger.
Doug Peta is Chief U.S. Investment Strategist at BCA Research.